Well, I'm delighted today to be recording this conversation with Neil and Justin from Buzzercot in London. Welcome to you, gentlemen.
Thanks, David.
Thanks, David.
So before we get into our conversation about the seismic changes in the res non-dom regime, it'd be great to have some quick introductions to you both. Perhaps you starting with you, Neil.
Yeah, so I'm Neil Lees. I'm a director in Buzzercot's private client team. So I advise individuals and trusts from a tax perspective. So in respect of tax advisory services, this can be about a wide range of matters. So it could be buying and selling properties, buying and selling businesses, or moving jurisdictions. I've got two key areas of focus really. So they are international clients, so those coming to or leaving the UK. And that is your classic UK resident, non-UK domiciled individual who might be in the UK for a period of time. My other focus is on succession planning, so helping clients generally, but in particular business owners, so helping them with pre and post exit sale planning, really helping them manage and optimise that process from a personal tax perspective.
Thank you. And Justin?
Hi, I'm Justin Stevenson and I'm an Associate Director in Buzzercot's Tax Investigation Dispute Resolution team. And I've been dealing with tax issues with HMRC for over 18 years now. CTA qualified, and basically my role is to resolve any disputes or matters with HMRC as quickly as possible. Very wide range of clients, from individuals, companies, trusts, anything in between, and any kind of tax that you can think of we actually deal with in resolving matters with HMRC. And I utilise my experience to kind of understand what HMRC want, take control of the process and resolve matters as soon as we can. In my previous life, I had a similar role to Neil and also advised high net worth non-domiciled individuals and offshore trustees. So I've had a bit of a specialism in that area in tax investigations as well.
And Neil, tell us a little bit about Buzzercot.
So we're about 650 people now. We're a single office firm, and on our floor there's 120 private client focused advisors.
Which is great because if we ever need to, we can always find a specialist in any particular area, whether that be private client or corporation tax, VAT. We're all under the same roof, so we can collaborate really well and give clients the best service.
Fantastic. So Neil, just to get us underway, give us the headlines. What are the recent changes affecting non-doms?
Yeah, well, to start with, the old regime, so that was very well established. That was the remittance basis for non-UK domiciled individuals. So put very simply and crudely, a non-UK domiciled individual is somebody who doesn't originate from the UK and does not intend to remain here permanently. So the remittance basis was open to those individuals, and it meant that they could be taxed on their UK income and gains on an arising basis like everybody else, but their foreign income and gains were only taxable to the extent they were brought to or otherwise used in the UK. Now, they did have to forego certain tax-free allowances to access the remittance basis, but it was otherwise free of charge for the first 7 years, after which an annual charge of at least £30,000 per annum applied. So once an individual became deemed UK domiciled, once they've had 15 out of the 20 previous tax years of residence, they would be assessed on a worldwide basis like everyone else. Now, this was also a crucial point for inheritance tax. So from that point where they became deemed domiciled, their non-UK assets would become within the scope of UK inheritance tax. And that was regardless of whether they previously claimed the remittance basis or not. So in summary, that was a tax efficient regime, but it was complicated. It required a lot of consideration, often a lot of detailed advice because it was difficult to administer.
So Neil, give us the lowdown then on the new rules that are in force since April.
Yeah, so the remittance basis has been abolished now since 6th of April 2025, and it's been replaced with a residence-based regime. Now, under this residence-based regime, for the first 4 tax years of UK residence, an individual can exempt their foreign income and gains. Now, in order to qualify, they have to be a non-UK resident for a consecutive period of 10 tax years, but it's regardless of their domicile status. So, UK dom, non-UK dom, it doesn't matter. Anyone can potentially qualify for the new foreign income and gains exemption. Now, what's interesting is the foreign income and gains has to be declared on their UK tax return for the exemption to apply. Now, this is a bit of a differential from the previous remittance basis, where only taxable events were required to be reported to HMRC, and everything else could be left out of account. Inheritance tax will also move to a residence-based regime. So once an individual has been resident for 10 out of the previous 20 tax years, they will be within the scope of UK inheritance tax on their worldwide estate. There's a lengthy potential tail that applies where even if you leave the UK, you could be subject to UK inheritance tax for a period of up to 10 tax years once you've left the UK. And that's one of the key parts of the new rule, that there's this very lengthy tail that could apply.
And might people use insurance for that tail? Like what are the kind of ideas that people are looking at before they decide on sort of bespoke advice?
Well, I think the first thing to identify is when will that tail apply to, because although it's up to 10 years, it could be shorter based on how long somebody has been UK resident. But insurance is definitely an option, general estate planning, whether the spouse's residence history is the same. So there's all sorts of, planning. There's also protection under some UK estate tax treaties as well, which needs to be considered. So there are things that can definitely be looked at.
And for non-doms who decide to stay, their tax compliance is going to get more complicated, isn't it? Because as you said, now they're going to have to disclose and look at worldwide assets, whereas before those assets were kept outside of the UK's kind of tax reporting system. Do you think it's going to make your average non-doms, even their tax return, more complicated?
Yeah, it will definitely, David, because, like you've mentioned previously, you didn't have to report anything that wasn't within the scope of UK tax. So it does mean that these foreign sources need to be properly identified, quantified each year on the tax return as they move to a worldwide basis.
And what about on the investigations side then, Justin? These new rules, very complex as transition. People are going to need to get their heads around this new regime. What are HMRC going to be looking at?
Yeah, absolutely. I mean, with any new rules, HMRC are going to be interested. They're going to want to know that advice has been taken. People have, followed that advice and got their affairs correctly. And of course, with offshore matters and non-domiciled individuals, HMRC have always had a big interest. There's always been a perceived risk of non-compliance, especially of those who've held assets in overseas jurisdictions that they would consider to be tax havens, so low tax or low compliance. So yeah, definitely expecting HMRC to be looking into it. And
these changes were well trailed. There was lots in the media about it, but those who've kind of missed the boat come through April, is it too late? What should they be doing to address their requirements right now?
Well, it's not necessarily too late to plan. Of course, the window for planning before the rules came into force has obviously closed, but there are a raft of transitional provisions that mean that there are opportunities for those who've transitioned from the remittance basis onto the new foreign income and gains regime, or they're now on a worldwide basis. Probably the biggest opportunity is the temporary repatriation facility, and this allows income and gains that were previously subject to the remittance basis to be brought to the UK in the next 3 years for a lower rate of tax. The rate is just 12% in the current and next tax year, and then it rises slightly to 15% in the 2027-28 tax year. And that's actually been expanded throughout the various iterations of the draft legislation, so that it now includes potentially distributions from offshore trusts as well. Now, those rules are complicated, but clients and advisors should be aware that there is the potential for beneficiaries to extract funds from offshore trusts and use the temporary repatriation facility of 12% currently. Now, there's also the rebasing of foreign assets as at 6th of April 2017. Now, this is 8 years ago, so whether it will have that much practical application remains to be seen. But there might be the odd golden nugget in terms of an asset that a client holds that can be realised for little or no tax because of the rebasing opportunity. For non-doms that are leaving the UK, there is still an opportunity within the current tax year, and this is all to do with that 10-year inheritance tax tail. So they have the opportunity to break UK residence in the current tax year and have a tail of only maybe 3 tax years, as opposed to the full 10-year tail that could apply under the new rules. So that's also an opportunity. And actually, just in some cases, if there's been a claim for the remittance basis with a lot of tax at stake in 2024-25, the last year of the remittance basis, it might just be sensible to revisit your domicile statement or just create one entirely, because that's the first line of defence should HMRC inquire into your return and start asking questions about your domicile status for that previous year.
So Justin, and on that domicile, give us a view from an investigator's perspective on domicile and what it means for clients.
Yeah, I mean, domicile has always been a bit of a tricky one, really. It's quite a grey area. Obviously, we're looking at an individual's intention at any given time, so it's quite hard to prove. one way or the other, and it relies on a lot of case law. So it can be quite difficult. So as Neil says, getting a domicile statement at the time is great because that really can close down any queries from HMRC. And domicile is still going to be important going forward. It's not going to go away because of these new rules, especially for myself in tax investigations, because HMRC can look back and they will go back up to 20 years. So unfortunately, I'm still going to be dealing with queries on individuals' domicile going forward. But yeah, I mean, HMRC will challenge it. They have in the past. There's been several cases recently where HMRC have won. I will say they've been quite selective in which cases they've taken to tribunal, but it's something we're still going to have to be alive to. And again, as Neil says, need to take appropriate advice at the right time.
And people can find dealing with HMRC very frustrating and time consuming. As a professional dealing on these big matters, you access HMRC perhaps in a different way. How's your relationship with HMRC as a professional dealing in these matters on a day-to-day?
Yeah, absolutely. I mean, the good thing is obviously we've got a lot of experience in dealing with HMRC. Myself, it's been over 18 years now. So we can work with HMRC and understand what they're asking, where they're coming from, and provide them information in a way that they also understand and appreciate, which just helps facilitate, resolution to the issue, because HMRC wants to resolve their inquiries as well, just as much as the client. So we work together collaboratively, try and take a proactive approach where we can, and that's the best way of dealing with it.
Do you sense they're ramping up their resources to tackle some of these new issues, to really raise the tax take? What's your sense of where HMRC are at in terms of their commitment to these areas like offshore and non-dom versus challenging other areas?
Yeah, I mean, absolutely. I mean, offshore has been a big focus for HMRC for many years. There's a perceived risk of lack of compliance in offshore jurisdiction. And of course, if people have been investing offshore with what HMRC would consider to be a tax haven, then they're going to want to look at that. And we have seen over the last few years, it's been well publicised, HMRC have been investing more and more in working on offshore matters. They've been utilising the information that they've received from overseas jurisdictions. We've seen a very successful worldwide disclosure facility campaign where that information has been used, and they've issued nudge letters to thousands of taxpayers who've been then asked to make a disclosure if they haven't fully disclosed. And that, again, has been very successful, and there's been a big tax take from that.
And there's more and more data available. There's more exchanges, aren't there, than rolling back 20 years or more, that jurisdictions are exchanging a lot. So it's not credible for clients to think, I've got my money in an offshore account. When will it come to light?
Yeah, absolutely. I mean, over the years, that sort of space of being able to hide things has shrunk dramatically, and there's very few places you'd feel comfortable putting your money now that HMRC wouldn't be aware of. So completely agree.
So why is getting the disclosure right on the tax return important?
Well, I mean, going forward, this claim's going to need to be made on the tax return itself. We don't know yet how that's going to look because it's the 25-26 tax return. But we understand that you will need to report the overseas income and gains that haven't been taxed. And of course, HMRC will have data from the overseas jurisdictions, and they'll be looking to cross-check that. And for those that don't tie up, they can expect a query from HMRC, and they will take a risk-based approach. So those with the largest assets overseas will be looked at first.
And Neil, what are some of the new trends? I mean, we're barely into the new tax year, but what are you observing so far?
Yeah, well, we, like others, have seen people leaving the UK, particularly the millionaires. They have left in significant numbers, and that's, been widely reported amongst the media as well. But I think, there are some positives regarding the changes, and I'd like to, spend a minute or two focusing on those. The first of which is, Justin's already touched on that domicile, it's a tricky concept. In many cases, it's hard to plan with a lot of certainty because of, the variability over which view HMRC might take. So moving to a residence-based regime should help clients have more certainty. The statutory residency test is more prescribed in terms of the factors. It's number of days in the UK, where your home is, where you're doing work, and where your family are. So, there's those more prescribed factors rather than domicile, which can be very wide-ranging. There are clients looking to come to the UK and make use of the 4-year foreign income and gains exemption. So that is actually more generous than under the remittance basis, that first 4 years, because income and gains can be brought to the UK without tax, which was never the case under the remittance basis. So, we do have, people who were UK domiciled previously, or potentially people who are looking to exit an overseas business coming to the UK and take advantage of that 4-year window. For UK domiciled clients who have always been taxed here, who are thinking of moving abroad, for them it was very difficult. It comes back to that point about certainty. At what point are they going to break their UK domicile? And so, although the tail is 10 years and widely regarded within the profession as being too long, it does mean that there is a point by which they can plan around and they can have a bit more certainty regarding their affairs. There's also, I've mentioned the transitional provisions, which, for example, the temporary repatriation facility. So that's, probably going to be widely used. The Office for Budget Responsibility, they predict that will generate £10 billion worth of tax revenues over its 3-year window. And we're seeing a lot of interest from clients who haven't left to fund their lifestyles in the short term for that, that lower rate of 12%, which is much lower than the 45% tax rate.
I'm seeing a lot in the press stories about Americans coming to London. I mean, as a practice, you deal a lot with US-UK matters. What are you seeing on that front?
Yeah, we're definitely seeing Americans still having the appetite to come and live in the UK despite the changes. I mean, for them, they are subject to federal tax, wherever they go in the world because of their US tax regime. So tax is not a primary driver. And as a result, they're still keen and coming into the UK to work, live, and are quite happy to reside here despite the changes.
And Justin, are there any other areas on which HMRC are focusing at the moment that you're observing?
Yeah, I mean, HMRC have got a wide range of things they're looking into at any particular time. In terms of trends that we've been seeing, property is a big one. Anyone that's been buying and selling properties and claiming principal residence relief, HMRC will be looking into that. SDLT as well, related to the property, HMRC are challenging that much more recently. And also, anyone that's been claiming a tax relief of significant sum can expect HMRC to check that and open an inquiry. So we've seen a number of business asset disposal relief cases and also overseas workday relief cases. Brexit has thrown up a few cases in terms of import-export duties. A lot of businesses have been caught out and not quite fully compliant with the new rules. So that's been something we've seen recently. And HMRC have really continued their focus in issuing what we call nudge letters, so one-to-many letters, where they're firing out lots of letters to many people saying, have you checked a particular point? And that seems to have been focused on the digital economy. So we've seen a lot of people who are online content providers, those that are selling or buying online. The platforms themselves are sharing lots more information with HMRC. So we're seeing a lot of interest in that area, and cryptocurrency as well has been a big one over the last couple of years.
And clients who are globally mobile, spending a lot of time in different places, including the UK, they can open themselves out if they're not careful with their records, their day counts, things like that. How do you see clients who do really move around a lot getting into difficulty because their record keeping is not up to date and current?
Yeah, I mean, absolutely. It's something that we do see quite often. That all of, as Neil says, the statutory residence test is great in that it kind of sets concrete parameters, but that relies on, as you say, adequate records being kept. And so we are still having disagreements with HMRC on individuals' residence purely because they haven't kept contemporaneous records of their whereabouts. And HMRC would expect very, very detailed records, especially if somebody's been working in the UK. Right down to wanting to see emails, phone records. So absolutely.
So just in summary then, Neil, I mean, how are you ready to help clients with these new rules coming in?
So in the private client team, we can help a client plan their affairs so that they're tax efficient in line with their wider aims and intentions. Now, there's been a lot of activity, currently, but also in the previous tax year. So we can really help clients with their tax compliance, and that's reporting those big events that are very complicated. So, for example, unwinding offshore trusts, moving away from the UK, or even just transitioning onto the worldwide basis for the first time. It's very important that they get those right. And that's actually something we can work well with Justin's team in making sure the disclosures are sufficient for HMRC.
Fantastic. And Justin, what about you?
Yeah, well, I guess for those that don't follow Neil's advice, I'll be there to help out when HMRC do come asking the questions. And also, obviously, when Neil and the team are giving advice to individuals, they'll be looking at what's happened in the past. Quite often issues are identified at that point, and it's important to try and get into HMRC with a disclosure before HMRC come to you, because that will be definitely beneficial in terms of penalties and the number of years that we need to worry about.
Well, great to talk to you today, gents, and we look forward to sharing this interview.
Thanks very much, David.
Thank you, David.